In this video, we are going to talk about recession. So before starting, please like this video and subscribe to this channel for our future updates. A recession is defined as a severe, widespread, and long-term decline in economic activity. A recession is generally defined as 2 consecutive quarters of declining gross domestic product, GDP. Economic output, consumer demand, and employment often fall during recessions. Recession. A recession is defined in the United States as a major fall in economic activity dispersed across the market, lasting more than a few months, and generally noticeable in real GDP, real income, employment, industrial production, and wholesale retail sales. A similar concept has been accepted by the European Union. The National Bureau of Economic Research, NBER, defines a recession as an economic contraction that begins at the height of the preceding expansion and ends at the low point of the succeeding downturn. Causes of recession. A recession can begin in a variety of ways, ranging from an abrupt economic shock to the aftermath of uncontrolled inflation. These are some of the primary causes of a recession. A sudden economic shock. An economic shock is a situation that occurs unexpectedly and causes significant financial loss. A more recent example of a quick economic shock is the coronavirus outbreak, which shut down economies globally. Excessive debt. When people or corporations incur excessive debt, the cost of servicing the debt can escalate to the point where they are unable to pay their expenses. The economy is subsequently capsized as debt defaults and bankruptcies increase. Too much inflation. Inflation is defined as a consistent rising trend in prices over time. Inflation is not inherently evil, but excessive inflation is a harmful phenomena. Inflation is controlled by central banks raising interest rates, and higher interest rates dampen economic activity. In the 1970s, out-of-control inflation was a persistent issue in the United States. To break the cycle, the Federal Reserve hiked interest rates swiftly, resulting in a recession. Attribute. A recession has numerous characteristics that might occur at the same time, including decreases in economic activity, GDP, component indicators such as consumption, investment, government spending, and net export activity. These summary measures represent fundamental causes such as job and skill levels, household savings rate, company investment decisions, interest rates, demographics, and government policies. According to economist Richard C. Koo, under ideal conditions, a country's economy should have net savers in the household sector and net borrower in the business sector, with the government budget virtually balanced and net exports near zero. An economic depression is defined as a severe, GDP down by 10%, or lengthy, 3 or 4 years, recession, while others claim that its causes and treatments differ. Stock market. Stock market falls have foreshadowed some recessions. Siegel writes in Stocks for the Long Run that 10 recessions have been preceded by a stock market decline, with a lead time ranging from 0 to 13 months, on average 5.7 months, while 10 stock market declines of more than 10% in the Dow Jones Industrial Average have not been followed by a recession. The real estate market frequently weakens before a recession. However, real estate falls can persist far longer. Because the business cycle is difficult to foresee, Siegel contends that it is impossible to use economic cycles to time investments. Even the National Bureau of Economic Research, NBER, needs a few months to establish whether a peak has occurred in U.S. unemployment. During a recession, unemployment is very high. Many neoclassical economists contend that there is a natural rate of unemployment that, when deducted from the actual rate of unemployment, can be used to estimate the GDP gap during recession. In other words, because unemployment never reaches 0%, it is not a negative measure of an economy's health, until it exceeds the natural rate, in which case the excess immediately equates to a loss in GDP. The full employment impact of a recession may not be felt for several quarters. After recessions in the 1980s and 1990s, it took 5 years for unemployment to return to pre-recession levels in the United Kingdom. History. According to the International Monetary Fund, IMF, global recessions appear to occur over a cycle lasting between 8 and 10 years. The IMF considers many factors when defining a global recession. Until April 2009, the IMF repeatedly communicated to the press that global annual real GDP growth of 3.0% or less was equivalent to a global recession. The IMF redefined global recession in April 2009 as a decline in annual per capita real world GDP, purchasing power parity weighted, accompanied by a decline or worsening for one or more of the 7 other global macro economic indicators: industrial production, trade, capital flows, oil consumption, unemployment rate, per capita investment, and per capita consumption. According to this revised definition, there have been 4 worldwide recessions since World War II: 1975, 1982, 1991, and 2009. All of them lasted only 1 year, while the third would have lasted 3 years, 1991 to 1993, if the IMF had used normal exchange rate weighted per capital real world GDP, instead of buying power parity weighted per capita real world GDP as criteria. The COVID-19 lockdowns and other government steps in early 2020 pushed the global economy into a recession, the second greatest in modern history. Australia. As a result of late 1920s agricultural profit concerns and reductions, Australia had its worst recession in its history in 1931–1932. It fared better than other countries that experienced depressions, but their poor economic conditions influenced Australia, which relied on them for exports and foreign investments. The country also profited from increased manufacturing productivity, which was supported by trade protection, which also served to mitigate the effects. A credit crunch has caused the economy to enter a brief recession in 1961. As a result, unemployment grew and the trade deficit widened dramatically. United Kingdom. The most recent recession to affect the United Kingdom was the 2020 recession attributed to the COVID-19 global pandemic, the first recession since the Great Recession. United States. The United States housing market correction, a result of the United States housing bubble, and subprime mortgage crisis both contributed heavily to the recession. Private consumption fell for the first time in over 20 years during the 2007 to 2009 recession. This demonstrated the extent and severity of the recession. Economic recovery took a long time because consumer confidence was so low. Consumers in the United States were particularly hard impacted by the Great Recession, with the value of their homes plummeting and their pension funds devastated in the stock market. Employers in the United States shed 63,000 jobs in February 2008, the largest in 5 years. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.